Hey traders, welcome to Master the Market, where we help you become a market master. In today's video, I want to talk about the top lessons that I've learned from nearly 10 years of day trading. If you're a new trader or someone that is a little bit inexperienced and struggling with your trading, I can say with confidence that these lessons are going to help you improve your trading in one way or another. So make sure to stay tuned through this entire video, get all of the lessons, and let's go ahead and get right into number one right now, which is going to be to widen your stop loss. Now that might sound a little bit confusing because you've probably always heard to cut your losses quickly, but for this lesson, I'm going to explain why it might be better to actually widen your stop loss and take a little bit of a larger loss than you typically would. So let's take a look at this chart here for NVNI. This is a stock that we can see is overall very clearly in an uptrend. However, if you are someone that is maybe buying into the VWAP here, thinking that it's going to run back up to the highs and squeeze to new highs, and then we get this dip underneath VWAP, there's a good chance that if you are a newer trader and you're keeping your stop loss tight, you might be stopping out once it breaks underneath the VWAP here, or maybe you bought in before and you're getting stopped out here, or later on as it dips below VWAP here, when in reality the best way to go about this probably would be to widen your stop loss out a little bit and look at the overall trend of the stock and use those previous lows in order to actually manage your risk. So if we take a look here, we can see that there are higher lows that are forming all throughout this trend. Even though they are dipping underneath the VWAP, they're still holding above that previous low, forming, of course, this overall uptrend. Uptrends, of course, are made from higher highs and higher lows. So if you were buying into this move here, for example, as it starts to bounce back above the VWAP, you would want to use that previous low for your risk management, and you would want to place a stop loss slightly below. The reason for that is because in an uptrend, these previous lows often form some support, and they're often going to be protected by buyers. So if the trend is going to remain strong, there's going to be some demand at that area, and it's going to most likely bounce back up and continue pushing higher. On the other side of the spectrum, if the trend is going to start breaking down and we're going to start reversing into a downtrend, you would want to get out quickly once a lower low starts to form in that move. So that's one example of why it would be better to use a slightly wider stop loss than you probably typically would. Now I do want to say and emphasize that using a wider stop loss should not mean that you're risking any more money on the trade. You can of course adjust your position size and size down in order to make sure you're still risking the same amount of money on every trade, even if you are using a wider stop loss. So instead of, for example, buying $2,000 of a stock with a 5% stop loss, that would give you a risk of $100 on that trade. You could try to just buy $1,000 of the stock using a 10% stop loss, still risking that same $100 amount, but now you're giving yourself an extra 5% in wiggle room to the downside for that trade to actually work out and move in your favor. Now again, the reason that this works and the reason that this is important is because if we take a look here at the scanners, for example, from Friday, these were some of the top percent gainers for the day. We have some up 30%, some of them up 50%, some of them up well over 200% even for the day. So you have to realize that if you're trading any of these big movers, which typically as day traders, we are trading these stocks that are moving a lot, that have a lot of volatility and a lot of volume. If they're moving 200% for the day, you have to think about how quickly they can move 5 or 10%. So if your stop loss is that close, you have to really be pretty perfect with your entry in order to not get stopped out before the trade really has a move to the upside or moves in your favor. So I don't want to necessarily say the wider the better with your stop loss, but I do know traders that many times are trading very volatile stocks, and if they're short selling a stock that's spiking to the upside, it's not uncommon for them to use a 30 or 40% stop loss on that short position from where they're initially entering into the trade. Okay, so let's go ahead and move on here to lesson number 2, and that is going to be to change your time frame. As day traders, we're taught that the shorter the time frame, the better for us as quick short-term traders, but the simple fact of the matter is that most traders, I would say probably 95% of traders, should not be using the 1-minute time frame. The 1-minute time frame is really only going to be most beneficial for traders that are getting in and out of very quick short-term scalp trades, 10, 20, 50 times per day, just looking for those very quick moves in a matter of seconds. If you're not one of those traders, which odds are you probably are not, you're most likely going to be better off with a slightly longer term time frame like the 5-minute chart. So I want to compare here these charts for Meta. Of course, these are taken on the same day. We have the 1-minute time frame on the left and the 5-minute on the right. And what I want to focus on here is this V action where it falls down and then starts to bounce right back up. What you'll notice here is as the stock is falling, there are quite a few different times where there are some small green candlesticks that form on this 1 minute time frame. We also see that there are some long lower wicks that start to form. All of those things really, if you are someone that was looking to buy Meta at the time, you would see those as potential buy signals, and you might start to scale into some trades here, scale into some here, even though the trend overall is very clearly to the downside, and those on the 1 minute time frame are really known as false signals. And if you compare that to what we see over here on the 5 minute time frame, we can see that it is a lot more clear that the trend is still to the downside this entire time until we get this big green candlestick that starts to bounce. So simply put, the 5 minute time frame is going to give you clearer levels. That might be support and resistance. It's also going to give you a clearer trend and clearer breakouts. That is why the 5 minute time frame, in my opinion and in my experience, is going to be much superior to the 1 minute time frame. Okay, now lesson number 3 is going to be to find your niche. If you compare the trading of an experienced trader to the trading of a new trader, you're going to see that the experienced trader, for the most part, is probably going to be trading solely one kind of niche. They might be an expert in, for example, short selling stocks at the market open. They might be an expert at maybe trading a gap and go, or maybe trading intraday momentum or daily chart breakouts, whatever it may be. Most experienced traders have one specific type of trade that they focus on, and that is their niche in the market. If you compare that then to a new traders are going to be trying to, buy the dip at VWAP. They're going to be trying to take daily chart breakouts, opening range breakouts, intraday momentum, gap down short setups, whatever it may be. They're really kind of spreading themselves too thin and trying to take on too many different types of trades. And ultimately, this is going to lead to them taking much more consistent losses. Now, I know obviously you're probably thinking that if you're a new trader, you have to kind of figure out what your niche is by taking on different types of trades. The simple fact of the matter is that, in my opinion, if you are a new trader and you don't necessarily know what your niche is yet, you should not be really risking any money. You should be doing some kind of simulated trading or some kind of paper trading to practice these different types of trading setups to figure out what your niche is. And then once you start trading with a real live account, you can focus solely on that niche. So very quickly, I want to show you how you can start paper trading with TradingView for 100% free. All you have to do is sign up for an account. It is 100% free to do so. You just have to put in your email and your name. And once you have that free account created here at TradingView, if you were to search, for example, Apple, and pull up the chart for Apple, the way that you can start paper trading and practice trading here in TradingView is by clicking on the trading panel down here at the bottom. And once that opens up, you're going to see an option here to paper trade. Click on that and connect your paper trading account. And right away, it's going to give you $100,000 of virtual practice money to paper trade and to figure out what your niche is without, of course, risking any real money. You can also do this in many brokerages and many different trading platforms like Thinkorswim. I think Webull has paper trading as well. So really, there are multiple different options that you can start doing this for free. And if you're not someone that's seeing consistent profits in the market, you really should be focusing more on paper trading for now until you have a better understanding of what strategy is going to work best for you. And then you can focus solely on that with your real live trading. All right, that's going to lead us now to lesson number 4. This is going to be to scale in and scale out. Another thing that you're going to notice if you compare the trading of a new trader to the trading of an experienced trader is that most new traders are buying their entire position all at once and then selling their entire position all at once, not scaling in and out of their trades. I want to take a quick look here at this chart for Meta. These were some of the day trades that I did here on Meta for this day, scaling in and out of multiple trades throughout this session. We can see, of course, that there are a bunch of different entries here and a bunch of different exits. I'm not just buying the entire position right away and hoping that it moves in my favor before it hits my risk level. I'm simply scaling in and building a position. And as the trade starts to move in my favor, and as my conviction in that trade gets better, I'm going to add more shares into it. And this is going to really just give you a lot more wiggle room for the trade to work in your favor. And on top of that, if you take, for example, a small starter position right away, and then the trade kind of moves against you and it starts to look like it's not necessarily a trade that you want to take, the good thing about that is you're only in a small starter position. So your loss is going to be much smaller when you decide to cut losses on the trade. On the other side of the spectrum, if you are scaling out of your trades, the nice thing about it is you're going to, of course, be locking in profits along the way. But on top of that, you're going to be holding on to some of your shares from your original position. So as the trade progresses and as it continues to move in your favor, you're going to really be able to maximize your profits on that trade. So I know this looks like a very chaotic chart, but all of this scaling in and scaling out was able to result in a $466 profit for me on this day, which most likely would not have happened if I was just buying and selling my entire position right away all at once. And all of that is going to lead us now to lesson number 5, which is going to be to get educated. I know most people don't want to hear this, but really the best way to kind of beat the learning curve of day trading is to follow in the footsteps of someone that has been there where you're at currently and that has been able to find success in the market on their own. I can say that really one of the biggest regrets that I have when I was a new trader is that I wanted to learn everything 100% on my own. I kind of refused to buy any services, buy any programs, and because of that, it took me multiple years of trial and error, and I ultimately lost thousands of dollars when I was starting off as a new trader, dug myself a pretty big hole, and it made it very difficult for me to ever find any success with trading. I know that if I would have put my ego to the side and just invested in my education for day trading, I would have ended up finding consistent profitability a lot quicker. So if you are interested in furthering your education, the Master the Market bundle is a really great way to get started in doing that. This is going to be a 9-course bundle. You're going to learn about day trading. You're going to learn about candlestick analysis, volume analysis, tape reading, different day trading strategies. You're also going to learn about swing trading and long-term investing and options trading as well. On top of that, when you enroll, you're going to get 1 free month to the Market Master group so you can trade with us in real time and see the type of trades that we're taking every single day. And as a bonus for watching this video all the way through, you can use the coupon code YTube25 for 25% off the Master the Market bundle. There's going to be a link down below in the description for you to get signed up. Anyway, thank you for watching. I hope you enjoyed and found some value in these top 5 lessons that I've learned from nearly 10 years of day trading. If you did, please make sure to give the video a like and subscribe to the channel. But thank you for watching. I hope you enjoyed, and good luck with your trading.